Hey, Market Chameleons. Thanks for joining us for today's morning show. It is, what is it, July 28th. This has to be episode 8, probably, Dmitry. Thanks for
Something
joining
like
us.
that, yeah. Thanks, everyone. Good morning. I guess before we get started, Will, you want to let's put up the disclaimer really quickly, like usual.
Sure.
Get that out of the way.
Sure.
Okay. And then we'll talk about a little bit about the pre-market movers, a little bit about earnings. We'll look at some stock screens potentially. So here it is, everybody. Market Chameleon, Will and I, we're not registered investment advisors. We're not broker dealers. We're not making any recommendations or telling you what to do. We're just sharing ideas. Of course, if you need the advice of a professional, then you should go and seek out the advice of a registered investment advisor or call your broker. So there you go. There's the disclaimer.
Awesome job, Dima. Before we get started, let's go over a couple things. Listen, put anything you want Dmitry to talk about in the chat. We try to get to any of your questions on YouTube. Remember to subscribe and like us on YouTube. It is always a big deal trying to get the Chameleon message out there. Also, I see some of the people are complaining about blurriness, and what I'll do is I'm about to send a link to the Zoom meeting we're having where Dmitry and I are pushing this out. You can join it, and there's a chat there if you are having problems with your video. I'm not sure why this live stream does this on YouTube. We're still trying to figure it out. But anyways, I'm about to send that out. With that, Dima, you can get started.
All right, cool.
This morning.
Good morning, everybody. So let's just start really quickly with the pre-market report, and two things I'm going to make note of that are coming up is we know that the FOMC is meeting tomorrow. We'll see what they say or any what they say about the economy and how they're thinking. Also, the GDP is coming out, I think, early Friday. So we'll see how that comes, what that says and how our productivity is. That's super important. And having said that, let's just take a look at what's moving today in the pre-market. And this report, as usual, is stocks that are right now trading in the pre-market hours. And we have it broken down by stocks that are most active in the pre-market, the biggest percentage gainers, biggest percentage decliners. I'm going to go to the top gainer up here, Kodak, and it looks like that's up 200% with its market cap of 114 million. And let's just bring that up and see what's going on here. I think they've had some news that they got a contract with the government, maybe to do some production for the government with related to the corona. Don't know exactly. I just saw some headlines there, but here we go. It's up 200%. The high 52-week high was $4.78. Today, right now, it's trading at $8.34. That's up 218%. On 18 million shares, that's compared in the pre-market hours, that's compared to a float of 12 million. So that's trading a lot already above its float. Here's the range, 280 to 875. You can see it's very liquid. I'm looking at the VWAP bars over here in the pre-market, and it looks like the bulk of it was trading at 722 to 771. That's 4.7 million shares in that range. Up at the top range, we get another 4.3 million shares between 820 and 869. So there's the concentration over there. See, that's the minute-to-minute standard deviation. So right now the VWAP is 741 with a standard deviation minute-to-minute of $1.63. Very illiquid in the pre-market, but just thought it was worth mentioning because that's a really big move for Eastman Kodak. Actually, let's just take a look at what its historical gap moves up, and these in the last 3 years, these are the biggest gap moves at the open. And we see here that the average is 13%. I see the highest over here, Jan 10th, 2018, 83% gap move. Nothing like we see today at 200%. Historically, when it opened up, on a large gap move, we see by the end of the day, it tended to drift lower 92% of the time for an average loss of 4.8%. From the open to the high, it looks like the average gain was 2.8%. From the open to the low, average of 7.6%. Of course, this has been a big outlier move on news. So we'll see what happens to this stock after the market opens. I'm going to come out here and notice one other one we've been talking about. Let's just switch this to ETFs. This is the silver ETF that's down 2.7%. And I think Will, correct me if I'm wrong, Chris Marcus is coming on Monday. He'll talk about the silver trade again.
Yeah, Chris Marcus, who joined us over a month ago, and he's, we've been talking to him for a while because he was an early user of MarketChameleon, and he's a big silver bug and has a lot of interesting ideas. I'll send a link to his channel out to everyone, but he's a super interesting guy, and he still thinks there's a lot of room for silver to move, and he's going to go over some ideas next Monday's show.
Yeah, so maybe we'll talk about some option plays around silver, and that's kind of like right now, the inflation play, right? So if inflation fears start to tick up, if people feel like, well, there's too much money being pumped out, not enough productivity, inflation goes up, these things tend to, the silver or the gold or commodities can really start to accelerate higher quickly. So he's going to talk about that, the silver with us on Monday, but here you go today. It's off 2.7% at the opening, but then again, it closed right near the 52-week high yesterday.
Actually, Scott from the YouTube chat is saying there was lots of unusual option activity in SLV yesterday.
In SLV, so maybe we'll go take a look at that as well. Yeah, let me go really quickly to the earnings, and then we'll go to the SLV options chain and see what was trading there. I'm going to go today to the, just to see what tended to happen with these small cap stocks that, because we get a lot of small cap stocks that have really big gap moves up in the morning. So let's just take a look in the last 2 weeks, what happened to these stocks after the market opened. They gapped up. What did they tend to do when the market started trading? So I'm going to go here to this report down below. And this is all in the last 2 weeks, we broke it down to mover, gap up and gap down movers. So over here, gap down, gap up. So let's just take a look at the gap up movers, and I'm going to go for market caps. Let's go low market caps, below 500 million. So I'm going to screen out. So this is our control group up here. These are all the stocks that gapped up in last 2 weeks. So we see that 51% of them after the open from 9:30 to 10 o'clock, 51% of them went up by 10 o'clock, 48% were lower. The average returns of all of them were negative 0.2%. To the close, from the 9:30 to the close, 43% of those that gapped up were higher by 10 a.m. 57% were lower. The average of all of those returns were negative 0.5%. Let's just now filter out, what about stocks that are market cap under 500 million? Let's look for gap moves above 20%, so pretty large gap moves, and see what did they tend to do. And let's see if there was news on them as well. So these are low cap stocks under 500 million. They gapped up 20% or more at the open, and they had news in the morning, some kind of catalyst. So this is how they compare. Only 31% of those continued higher from after 9:30 to 10 o'clock, 67% decreased, but the average return was 1.6%. So some of them you can see had pretty big gains. Let me see, till 10 a.m. So this is here, gapped up 81% at the open, and then continued higher for another 107% gain. So that's how this is. This opened up 136% at the open, 209 by 10 o'clock, it was 296 for another 41% gain. So that's what these 10 a.m.s are. But 67% of them declined after the open. By the close of the day, so this is the opening price. By the close of the day, that's what we're comparing over here. 30% of them and increased in price after 9:30. 70% of them were lower from the opening price. So that's what this is. So based on this group did worse than the overall group over here. So 70% of them lower on average. There's a 6% decline on average. If you did all the trades that fit all in the last 2 weeks, if you took these parameters and did all the trades on average, that was a 6% loss in share price. So that's really quickly how to filter out the last 2 weeks and kind of just see what stocks, similar stocks, tended to do. I'm going to go to let's go to the earnings calendar and just see what has been reporting in the morning. So this is today's earnings calendar, and let's take a look at before the market opens. So most of these stocks are already reporting. You can see they already issued press releases. We see Pfizer, they reported pre-market, that stock's up 2.9%. The straddle was implying a 4.5% move in either direction. So this is the expected move of the straddle. So buying a call, buying a put, what was the market expecting to move in either direction? So that's how we're comparing it here. So that's up 2.9% versus an expected move of 4.5%. Of course, the market didn't open. These could change. These are pre-market. McDonald's expecting an up or down move of 3%. That's down 0.9%, almost 1% pre-market. 3M, that was expecting a plus or minus 4% move. That's down 2.6% in the morning. S&P Global, that's up 1.8% versus an expected move of 4%. So Philip Morris expecting a 3.7% move in either direction. That's moving 2.3%. So we could see here that so far, the top 4 or 5 that I looked at, the moves have tended to be more muted than expected. I'm going to take a look at how that compared in the last 4 quarters. So we see here Pfizer, that as of yesterday was expecting 4.5% move, and according to the historicals, that was 1.4% above the historical 4-quarter average move. McDonald's, that was expecting a 3% move, which was about 1.1% above its 4-quarter average. 3M expecting 4% move, that's 0.7% above its 4-quarter average. And then, so this one down line. So we could see that so far the expectations were more overestimating versus the 4-quarter average moves. This is the 12 quarters average moves here, and we see how they did in the morning so far. So this is just really quickly going through what reported. Let's take a look at what's reporting today after the market close. We have Visa here. That's expecting 3.1% move. Amgen right now expecting 3.2% move in either direction. Starbucks, that's expecting 4.3% move in either direction. Advanced Micro Devices, that's expecting 9% move in either direction. So let's compare that to its 12-quarter average. So Visa versus 12-quarter average, it's right now expecting 3.1. That's 0.9% above its 12-quarter average. Amgen is 0.8% above its 12-quarter average. Starbucks 0.4. So it's not even that much higher than its 4-quarter average. And we see that here's the max moves in the last 12 quarters. 4.8% for Visa, 5.7% for Amgen, Starbucks 9.7%. That's a different way. We usually use a different report. So this is one way to look really quickly if you're just looking at today's upcoming earnings, maybe after the market close, and get a sense of where the expectations are versus the historical averages. Let's take a look at, what did we say, silver?
SLV we were discussing.
So I'm going to go to the silver options chain. We see yesterday 1.4 million options traded hands. Let's take a look at, so here's the volume. So yesterday 1.4, a little bit over 1.4 million option contracts traded hands. That's compared to roughly 300,000 average daily volume using the last 90 days. So we see that, that's that's a lot more, almost what, like 5 times more. Let's take a look at the options chain and see where that volume has been concentrated. So this is the options chain here, and these are all the different expirations, and these are the volumes for each expiration. One thing we see is that implied volatility is moving up. So this is the implied volatility for each of these expirations. We see July 31st up 19%, August up 24%, August 14th up 22%. And this is what we talked about a little bit with Marcus, where Chris Marcus, when you're saying, remember when commodities move up, they act differently than regular stocks that move up. So you see when regular stocks tend to move up slowly and more orderly, the implied volatilities usually decline as there's more certainty and stocks move up. Commodities can behave differently, because as commodities are moving up, it could be because of inflation fears, and you'll see implied vol starting to move up. So let's just take a look here. Let's go out a little bit further, August 21st. And let's just see how these implied volatilities, so this is August 21st, 19 business days out. These are all the different strikes. So we could see here today, it closed at 22.83, and this side is the calls. And let's just take a look at the calls. As we're moving up in strikes, these are the different implied volatilities, right? So this is the at the money around 59.6. That's the implied volatility of this call on the bid. This is the implied volatility of the ask on the offer. So we see here, as you're going up in the strikes, the implied volatility is increasing. So the expectations are, if we climb this, if we're going to be going higher in silver, it's going to move faster, right? It's going to accelerate as it's moving higher. Does everybody see that? Hopefully, we call that the reverse skew. So this, let me see if I have a skew in here. Let's just come in here, take a look at so this is what the skew looks like, a 30-day constant maturity. You start from at the money, and you see that as you're going up in strikes, the implied volatility is going up. So that's what the skew looks like on a 30-day constant maturity.
Which is always interesting to see, because it's completely opposite what you'd see in a typical stock or ETF.
Right. So if we brought up SPY, you would see actually the reverse of that, where the skew is going up to the downside as the strikes move down, and then these, as you're moving up, the implied volatilities are coming in. So this is the difference between something like a silver and a stock. Of course, you might see this in biotech too, right? So some biotechs or any stocks that may accelerate really fast to the upside. Let's just see the volume really is spread out right now. I don't see big concentration in any one particular expiration. You know, we have 200,000 contracts July 31st, August 203,000. So the volume it's trading a lot of volume, but it's not concentrated on any one particular expiration that sticks out to me. It's spread out pretty well. Let me just take a look. Let's go back to August 21st. I'm going to see, this is right here. I just put the most active call. So the most active call on the August 21st was this, the 23 call line, and the put was the 20.5. So let's just take a look at this strike. And we see right away that this is what happened July 24th. The market closed in this option 65 cents, 66 cents. This is the implied volatility 55. July 27th, the market went up. So the option was closed at 141, around 141, $1.41. with implied volatility ticking up 59.6. So we see that the stock gained 7.7, implied volatility increased by 8.1. There are 18,194 contracts traded on that line. The total notional value of all those options trades was 2.2 million, traded as high as $1.59, as low as 99 cents for a VWAP price of $1.25. So closed a little bit higher over that VWAP. The volume weighted average implied volatility traded was 56.2, as high as 70.2, and as low as 46.5. So it closed a little bit above that volume weighted average implied volatility that's been trading at. So that's just quick view of, let's just take a look, one more thing.
The someone is asking in silver to look at the benchmarks and the risk reversal benchmark they want to see.
Sure. So I'm going to get, before we go to a benchmark, this is just showing you the daily changes in this particular option. And I just brought it up just to see how quickly the open interest is climbing. So we could see here from July 14th, this option was 6 cents, closed at 6 cents with open interest of 14,000 contracts. Then it kind of started to, as it moves up, you know, we see it increase 6 to 16,000 open interest. And on July 22nd, we see the open interest increase to 29,600, where that option gained on that day 344%. And that implied volatility went from 48 to 65. So not only is the option increasing due to the delta, the implied volatility of that option has been increasing as well. The question was the benchmarks. I'm going to go for those that haven't seen these benchmarks before, as we take because you could have so many different strategies in all these stocks, what we do is benchmark the strategies, and you could compare what are the current costs of doing the strategy versus a historical cost. So, you know, if, for example, just if you take a plain call, if a 5% out of the money call, for example, for 30-day constant maturity, if you would pay, you know, 1% premium on average, then we compare, well, what's today's premium versus the average. This here is, we start out at the risk reversal. This is looking at a 30-day constant maturity. So an option that would be 30 trading days out. If we're to buy the 5% out of the money call and sell the 5% out of the money put, right now, it would cost us 0.9% debit premium. Historically, that the 52-week average was 0.4%. So today's skew, it would cost us more to buy the 5% out of the money call, sell the 5% out of the money put. That's how we look at this risk reversal.
It's interesting. I mean, I'd have to go back to the video from a month ago with Chris, but when we looked at it then, I think it was actually 0.2. It was under debit.
Yeah, maybe it was, because when he was telling us, I remember where like you could do that trade now. When he was, silver was lower at the time.
Yeah, no, I get it, but
yes,
this, you know, I don't know, a long-term chart of silver. I think silver was in the 200s at one point historically. I mean,
yeah, that's what he was saying. We're still way below.
The velocity of the move to the upside, like you've talked about, could be significant. If it's, yeah,
exactly. And the idea behind what a risk reversal is, let's just take a look what a risk reversal, and this is kind of what a risk reversal would look like, where you break above the long strike, above your 5% out of the money call. At expiration, you just start making money. It becomes kind of like stock. Once it's in the money at expiration, just keeps going. It becomes like stock. In between the strikes, it's uncertain, depends whatever, you know, these will expire both worthless. So you're either going to make or lose based on what you paid for the strategy. If it falls below the put, so below this 5% out of the money put, then again, that put, it's going to go 1 for 1 with the stock as it's going lower. so at expiration, it goes below the strike.
Yeah, you're either going to have to cover the put or
hold,
take
yes,
delivery of silver at that strike.
exactly. So it's like you own silver, at that point. It's like you bought the silver below that strike, or you bought the silver above that strike. So that's how it is. And then you have this like middle gray area. They both expire worthless. So you're going to either make money if you sold it for credit, or lose money if you bought it for debit. So in this case, that's a debit. So that's how it would look right now. And let's just go to the options chain. We'll set it up so people can see. So this is 29 days out, and I'm going to find, let's just find like here's a 5% out of the money call. So let's say we buy that for $1.38. And here's the closest one is a 5.8% out of the money put. So we sell that for 105. So here it is in September, buying the 24 call for $1.38, selling the 21.5 put for 105. I'm going to run that strategy. So this is what it looks like. We're paying a 33% debit. So that's in between the strikes. If the stock expires anywhere in between, we lose that 33 cents we paid for the strategy. If it goes above this, the 24 strike and covers this debit, after that, it just acts 1 for 1 with the stock. So it'll just go up 1 for 1 with the stock. If it goes below that strike, 21.5, then we start losing 1 for 1 with the stock at expiration. And so that's what it looks like, a risk reversal. Just wanted to show how you would set that up.
Yeah, that's awesome. Now, one question to get the 5% out of the money. You did that really quick. Can you just show the people how they hover over the strike?
If you just hover over this tells you how far away the strike is from at the money. So once you hover over it, it'll just tell you. You're not gonna always find exactly 5%. And you don't have to. You could stretch it out as well. You could do like 10%, and then I could find something.
Yeah, I can't even tell you how in the olden days when we had paper sheets, how we used to try to do this. I mean,
right. You would have to kind of guesstimate. Yeah. So this would be 10%, away on both sides. And it's just, this one's 45 cents. This would cost 45 cents to put on. Again, that's just really quick to give you easy reference if you have a percentage in mind. Is there any?
We had and I think you may have touched on it, but the show moved by so quick. Someone was asking about AMD. I think they may have earnings coming up.
Okay. So AMD, that's today after the market close. Let's just take a look at what the stock tended to do first. And these are the last 12 quarters. This is what AMD tended to do. So heading into earnings, we see that, at least 2 days, 1 day into earnings, it tended to move lower, 67% of the time on average, and an average loss of 2.1%. Day before earnings, 75% of the time, it tended to sell off for an average loss of 1.8%. The opening gap, it's really 50-50. Half the time it opened higher, half the time it opened lower. The average of the gap moves was 0.2%. But let's just take a look at the magnitude of the gap moves. So if we converted all these into positive, just to see how far away it moved. And on average, the absolute move has been 7.4% up or down, with a high move at the open of 21.4%, which would be right here, 21. It moved down 21.4% on October 24th, 2018. After the gap move, another thing that I notice is that the average move for the stock has been 9.2%. So what this is telling me is that it extended whatever the move was. It continued either If it was lower, it continued lower. If it was higher, it continued higher, because the actual move for the day was the absolute average move for the day was 9.2%. So after the gap move, it tended to even move more. And we see here that from the opening to the close, it's also 50-50. So there's nothing here. No trend here. Half the time it moved higher, half the time lower. Let's see what it did coming out of earnings. So it's 50-50 the next day. Half the time, it was higher or lower, maybe just slightly weaker coming out of earnings, 2 days, 3 days. So you see here the percentage moves. That's pretty quickly using the historical stock behavior. Let's look from an options perspective. So AMD here, these are the last 12-quarter moves versus the implied moves. So these bars over here, that's the implied move up or down. The red or green is the actual move, and it lets you compare if the actual move exceeded the expected move, like we did, like over here in this green range, where it was up 19.9% versus an expected move of 12.3%. Here it exceeded the move to the downside, 15.4% versus an expected move of 14.6%. So this is a quick visual how the stock behaved versus the expected move from the options market. We see here that the markets were overestimated to move 50% of the time, underestimated to move 50% of the time. So really almost like in line there. The average implied move before the earnings was 10.6% versus an actual move of 9.2%. So very close, maybe 1.4% differential there. Being long the straddle in the last 12 quarters was a winner 50% of the time, 50% of the time was a loser versus an average loss of 6%. Long strangle, same thing. Half the time it was a winner, half the times it was a loser, but the average return was negative 26%. Credit iron butterfly, that would be selling the straddle, buying the wings to protect yourself. That was also half the time it was a winner, half the time it was a loser, but the average gain was 4% versus credit iron butterfly, which was selling out of the money call spread, selling out of the money put spread. That was a winner 55% of the time for an average gain of 7%. Let's take a look at what the implied volatility tended to do.
Demon, we're about a minute away from the open.
Okay. Yeah. So thanks everybody for joining us this pre-market show. We really appreciate it. We love you guys. Thank you for your support, and hopefully you have a great trading day, and we'll see you tomorrow.
Yeah, you guys are the best. Again, thanks, Dmitry. Great job. Thanks for joining us. We'll see you tomorrow. Have a great trading day, everyone. Get to those terminals. Stay safe.
Bye, everyone.